5 seconds to
and
go.
see what we've got. I've got that time on my diary here, so let me see if I can get to that. Here we go.
Refreshing.
Let's hit the refresh. And are we going to get a read?
Come on. Everybody's going to be doing this today.
Yeah, everyone. It's probably. Yes!
We have a rate cut.
Okay, so we got the rate cut. It's 0.25. We didn't get the 0.35. We even didn't get to talk about that prior.
This makes no sense anymore. So
Well, tear it up.
I'll
Tear
throw
it
that
up.
on the floor. Let's go on. Come on, let's go and have a look at it.
All right, here we go. So we're going to go into the monetary policy statement, and what do we learn in terms of underlying inflation is moderating.
So it's no longer, as it said before, remaining too high.
What do we say?
Too high. So in the December quarter, inflation was 3.2%, which suggests inflationary pressures are easing a little more quickly than expected. Okay. There has been continued subdued growth in private demand. Now,
Where's
that
my
is,
$50?
Yeah, it's in my pocket. I'll get it out. Double or nothing on that one when the next one
Yeah,
happens.
we'll do that.
These factors give the board more confidence that inflation is moving sustainably back to the midpoint of both. Okay.
Yeah.
Upside risk remains. This is what we're going to talk about probably after this around the global issues
Let's
that
get
come
serious
with
now.
this and coming off to it. And outlook remains uncertain. So here's the new statement that Ben's just been handed by our brilliant production team. I want to go through a few other things that are on there that are catching my attention. Growth output is weak.
Yep.
Right? So that is what Ben was talking about before. The handbrake
Justification
is there. They need to release it. We cannot keep it for any longer. Private domestic demand is recovering a little more slowly, and that's probably fair than earlier expected, and there is an uncertainty around the extent to which the recovery in the household spending in late 24 will persist. So again, that was part of what I was also pointing to that I was slightly concerned about, is that in October, November, during, you had all the new Black Friday, Cyber Monday sales, those kinds of things, the household started to spend again and started to spend probably above trend in terms of where we saw. What they're saying is it's transitory. It's not actually a structural change. We'll wait and see. And I think that's also part of what it is. I love the next one. I know this has been something of yours, which is wage pressure has eased a little more than expected. Now, that's true, but wages are still technically growing at the fastest rate they are in 12 years. This is the bit. The sustainably returning to inflation to target is the priority.
What we're seeing in this statement really is also some narrative around this idea that don't expect the floodgates to open.
Yep.
So they will ultimately be data-driven in terms of some further easing that they may do, because there's a case in here in terms of for at least one more cut, consumption slower than expected, resulting in continued subdued growth outlooks. Uncertainty around the outlook also remains significant. So geopolitical and policy uncertainties.
So second to last statement, I think, is the most telling one. Forecasts published today suggest that if monetary policy is easing too much too soon, disinflation, which is obviously inflation that's falling, could stall, and inflation would settle above the midpoint of the target range. In removing a little of the policy restrictiveness, in today's decision, the board acknowledges that progress has been made, but is cautious about the outlook. So that is why the double or nothing bet will be, when is the next one?
All right, so let's have a look at the employment/unemployment data. So what do we say? Australia's seasonally adjusted unemployment rate inched higher. So this is the December number. The January number comes out in a couple of days on the 20th. The number of unemployed rose by 10,300 to 604,100. And of those seeking full-time jobs, advanced 14,900 to 412,100 people. So in theory, there's 412,100 people looking for full-time work in the marketplace that haven't got it. Now, those looking for part-time jobs fell by 4,500 to 192,100. It's summer. I'm going to go off and enjoy my summer, and then I'll potentially come back and do some work later on. The overall employment grew by 56,300 to a new peak of 14.58 million. Now, that's easily topping the forecast of 15,000. Part-time employment also climbed 80,000 to an all-time high of 4.55 million, but full-time employment actually declined by 23,700 to 10.04 million. It's a very, very good indicator in terms of what to look at. And so that's why we always rate it just straight under the inflation data in terms of what's important in terms of driving inflation. All right, now we're going to talk about the consumer. This is the other big ticket item. So if I'm going to get $250 in my back pocket now, what am I going to do with it? If I'm going to get another 2 rate cuts potentially, what am I going to do with $750 a month? So all of a sudden it now starts to play. Now what we did see in terms of the month-on-month read was just a slight variation. So just a slight tick up, but still in the pessimistic. So you might be saying cautiously optimistic / pessimistic. It's just sitting in there. But remember, 100% anything above is optimistic and pessimistic. But I want to highlight a couple of ones in here. So in terms of financials from a year ago, we're hurting, right? Our savings rates are going down. We're still spending, but ultimately we're absolutely digging into those savings. And in terms of those people you were talking about before, that bottom quartile of people in this country who have had it really tough, ultimately they are taking on a bit of credit and a bit of personal debt, and that's not great. So from that point of view, we definitely want to help them out as much as we can. Family finances next 12 months, that's actually looking okay. Because here's the other thing, right? This is the one about sentiment. Everyone thinks that property prices just keep going higher. That reading there is just crazy. But it's again, okay, interest rates are going to go down, so property prices are going to go higher. So this is about, timing the market and sort of the opportunities you've got in different markets. The businesses aren't spending like they potentially used to. So we're hoping that this confidence boost will come around and that will kickstart the economy. So less of our taxpayer money pumping up the economy and more of hopefully business and private investment doing that pumping up as well. Purchase cost grew, a growth rise of 1.1% in quarterly equivalent terms, and labour costs edged up to 1.8%. So then we look at the price. The product price growth stayed at 0.8 of 1%, and retail prices gained marginally to 0.09. And the chief economist from NAB, Alan Oster, great guy, summed up by saying that while demand remained resilient, we saw growth in the economy likely remains soft. So let's see what this little cash rate adjustment will do for that. So there you go. That's a sort of bit of a wrap in terms of what we saw there.